What if I told you that investing just $100 a week, less than what many spend on coffee or takeout, could grow into a 6 or even 7-figure portfolio just by picking the right dividend stocks and staying consistent? In this video, I'll show you 5 must-have dividend stocks for 2026 that not only offer strong yields, but also long-term stability, pricing power, and consistent growth. These aren't random picks. These are hand-selected names that have weathered recessions, raised their payouts for years, and sit at the intersection of income and resilience. But before we dive into the list, let's go over a few essential dividend investing rules that will guide everything we're about to discuss. Welcome back to the Trade Savvy Academy. Rule number 1: consistency beats timing. You don't need to perfectly time the market. What you need is to consistently invest, especially during downturns. Dollar cost averaging $100 per week can smooth out market volatility and take emotions out of the equation. Rule number 2: dividend growth is king. A high dividend yield is great, but the real wealth comes from companies that grow their dividends year after year. That growth means your income compounds without you doing anything extra. Rule number 3: reinvest your dividends. Reinvesting is like adding rocket fuel to your returns. Those extra shares keep generating more dividends, and the cycle compounds. It's how a $5,200 per year investment snowballs over time. Rule number 4: stick to quality. We're not chasing yield traps or unstable companies. We're focusing on strong balance sheets, predictable cash flow, and moats that protect these businesses from disruption. Now, let's dive into our top 5 dividend stocks for 2026, but I'll be revealing them one at a time, so make sure you stick around till the end to see which one takes the top spot. Coming in at number 5 is Verizon Communications, ticker symbol VZ. This telecom giant is known for its reliable 5G network, nationwide coverage, and strong free cash flow. Verizon has a juicy dividend yield of around 6.6%. And while its stock price hasn't been flashy, it's the kind of slow and steady performer that works well in an income portfolio. With over $130 billion in revenue and $17 billion in free cash flow, it has the scale to weather economic slowdowns. Trading at a PE of 10.35, it's undervalued, with analysts giving a moderate buy rating and a $48 price target, implying 9.34% upside. Verizon's 20-year dividend increase streak and recession-resistant business make it a safe haven, yet it's often undervalued due to debt concerns that are already priced in. It's not about wild growth, it's about income stability, and that's exactly what VZ delivers.
At number 4, we have Altria Group, ticker symbol MO, a consumer staples giant known for its high yield and defensive qualities. Altria dominates the US tobacco market and is diversifying into smokeless products, ensuring long-term relevance. It offers a robust 6.8% dividend yield with a payout ratio of around 75%, supported by strong cash flows. Trading at a price-to-earnings ratio below its sector average, MO is undervalued, with a consensus hold rating but a price target of $57.71, suggesting stability. Altria's 50-plus years of dividend increases make it a dividend king, and its defensive nature shines in volatile markets. Despite its high yield, it's often ignored due to sector stigma, but its cash flow reliability is unmatched. Investing $100 weekly with a 4% dividend growth rate and 7% price appreciation could grow to $36,000 in 5 years, $100,000 in 10 years, $400,000 in 20 years, and $1.5 million in 20 years, showcasing its income-generating power. If you're finding value in this video, please show your support by hitting the like button and subscribing to the channel. It helps me keep creating awesome content for you. Our third pick is Bank of America, ticker symbol BAC, a financial powerhouse that's quietly building wealth for investors. Operating across consumer banking, wealth management, and investment banking, BAC boasts a diversified revenue stream. As of mid-2025, it trades at a PE ratio of 14.61 and a forward PE of 11.5, indicating undervaluation, with a dividend yield of just over 2% and a low payout ratio of around 30%. leaving room for future increases. BAC has raised its dividend for 11 consecutive years, and with the financial sector leading markets in 2025, it's riding strong momentum after breaking resistance near $48. Analysts give it a moderate buy rating, with a price target suggesting stability and growth. BAC's scale and resilience make it a must-have, yet it's often overshadowed by tech giants. With $100 weekly investments, assuming 5% dividend growth and 8% price appreciation, your portfolio could reach $34,000 in 5 years, $90,000 in 10 years, $350,000 in 20 years, and $1.3 million in 20 years. Next up is a utility favorite, Consolidated Edison, ticker symbol ED, a utility giant that's a cornerstone for income-focused investors. This New York-based company provides electricity, gas, and steam to millions, with a stable, regulated business model that thrives in any economic environment. As of mid-2025, ED offers a dividend yield of around 3.3%, with a payout ratio of about 60%, signaling sustainability. It's a dividend aristocrat, having raised its dividend for over 50 years and trades at a PE ratio below the utility sector average, suggesting it's undervalued. Analysts rate it a moderate buy, with a price target indicating modest upside as demand for reliable energy grows. Why ED? Its defensive nature and consistent cash flows make it a safe bet for steady income. Investing $100 weekly, assuming a 4% annual dividend growth rate and 6% stock price appreciation, could grow to approximately $32,000 in 5 years, $80,000 in 10 years, $300,000 in 20 years, and an impressive $1.1 million in 20 years, thanks to the magic of compounding.
Finally, taking the #1 spot is the Hershey Company, ticker symbol HSY. A sweet spot in the consumer staples sector, the iconic chocolate brand that powers everything from Reese's to Kit Kat in North America. This iconic chocolate and confectionery company benefits from consistent demand and strong brand loyalty. As of mid-2025, HSY offers a dividend yield of about 2.8%, with a payout ratio of 50%, indicating room for growth. It trades at a PE ratio slightly below its sector, suggesting fair valuation, and has increased dividends for over a decade. Analysts rate it a moderate buy, with a price target indicating 10% upside as global snack demand grows. Hershey's stability and growth potential make it a hidden gem, often overlooked for trendier consumer stocks. With $100 weekly investments, assuming 5% dividend growth and 8% price appreciation, you could see $33,000 in 5 years, $88,000 in 10 years, $340,000 in 20 years, and $1.25 million in 30 years, fueled by steady demand and reinvested dividends. Now, let's combine these 5 stocks into a diversified portfolio to turn $100 weekly per stock, $500 total weekly, into $1 million. By equally allocating $100 weekly to Consolidated Edison, Bank of America, Altria Group, the Hershey Company, and Verizon Communications, you're spreading risk across utilities, financials, consumer staples, and telecom, balancing high yields and growth. Assuming an average 5% dividend growth and 7.5% price appreciation across the portfolio, your $500 weekly investment, $26,000 annually, could grow to approximately $165,000 in 5 years, $450,000 in 6 years, 10 years, $1.8 million in 20 years, and a staggering $6.8 million in 30 years, thanks to compounding and reinvested dividends. To reach $1 million, you'd need about 15 years with this strategy, assuming consistent contributions and reinvestment. These stocks are stable, undervalued, and built for the long haul, making them perfect for 2026 and beyond. Want to start building your $1 million portfolio? Drop a comment below, hit that like button, and subscribe for more wealth building tips. See you in the next video.